Well, hello everybody and welcome today to BMT Tax Depreciation's webinar on tax depreciation schedules, on tax depreciation for property investors. My name is Bradley Beer. I'm the CEO of BMT and I've got just under, well, next month it's 26 years of time at BMT doing depreciation schedule. In that time, we after starting in a spare room, or a little bit before I started, this business is now about 200 staff. We're spread all over the country, and we've done 900 and something thousand depreciation schedules. Expect sometime in the next year to click over 1 million depreciation schedules. So lots of depreciation schedules. It's been our main focus for a lot of that time. We do them all over the country for all types of residential commercial properties. What I would like to do today is we're going to run a look. What does it mean for you as investors? So thank you for coming today to learn. What it means is money. So I guess that's a reason to come. You buy investment properties. I am a keen property investor. I've bought and renovated and developed some small stuff over the years and held them. Claimed lots of depreciation on them as well. So I'm a keen investor, and you know, it makes a big difference. I make money out of investing in property through capital growth and through cash flow. Depreciation is, you know, the second biggest deduction you make, and a big difference to the cash flow of investment property. We're going to run through how that works today, what it's about. I give you some of the tips and tools to help you, I guess, on the journey to understand a little bit about depreciation, so you can use it to help that cash flow, I suppose, and how we do it. We've just got some tools to help you on the investing journey, which we'll run through on part of the session today as well. We'll go for about 45 minutes. You can answer questions on the way through. If we don't get them, sorry, you can ask questions and we'll answer them on the way through. If you've got more questions, feel free to send them whenever you like. Tomorrow, next day, if something comes up, we always love to answer questions, depreciation, where we can. So let's get into it. What is it? Wear and tear on a building. We kind of, when we use the word depreciation, I think the easiest analogy is to talk about a car, because we all understand that one. We buy a car, we drive it out of the shop. It depreciates in value pretty badly, pretty quickly, usually, and it's worth heaps less money. If you've got that car and you use it for business, the tax office will let you claim a deduction for your loss against that a car and it kind of works similar for property if you use it as an investment. So not for your house that you live in, because that's your principal place of residence, but for any income producing property or available for income producing property, this depreciation or wear and tear for the building and the things in it is a deduction you can make. So it makes a pretty big difference, a significant savings, second biggest tax deduction you'll make, and makes a big difference to the cash flow. The thing about depreciation, people say I'm buying a property for it to go up or appreciate in value, which is absolutely the case, but the things within there there is wear and tear on the bricks, the floors, the carpet, the hot water service, all these things wear out. So the value, or there's a decline in value of these items because they become secondhand and older, and you get to claim a deduction based on that wear and tear and wearing out. I'm a quantity surveyor. Why does a quantity surveyor do depreciation? Lots of people think it's my accountant, isn't it? Or that I've got a good accountant. We're not accountants, we're quantity surveyors. So I've done a building degree. What a quantity surveyor is someone who knows how to measure and estimate buildings. So we can get your set of plans for your property or building, and we can measure up how much concrete's in it, how much steel, how many bits of timber if you want, how many, you know, the doors, the carpets, the hot water service, everything that's in a building, we can measure, work out how much that is all there and what it should cost to buy it and to get it there or to build it. So we would work for different people in the construction process as quantity surveyors, maybe before they're building something, or while they're building something, or when you're finished, looking at what it did cost to build for the purpose of things like depreciation. So at BMT, we focus purely on depreciation, the depreciation component of quantity surveying. But obviously there's a reason we get involved, and it's because the claims relate to the construction cost. So the ATO says they want if you don't have all of the actual costs of construction, they want someone to estimate that cost that's recognised as a relevant professional, such as a quantity surveyor, to come up with the construction costs, which is under that taxation ruling 9725. If you really want to look it up, you could read that one. The other piece of making sure we get the most out of being involved in this is knowing the rules and knowing what we can and can't do. We have worked out the tax rules properly. We are a tax agent for the purpose of preparing a depreciation schedule, not for doing tax returns, because not accountants doing tax returns, but we do need to be a tax agent to do depreciation schedules, which we are for the Tax Practitioners Board. And just knowing and making sure we apply all of the rules to make sure we get the most out of it is what's very important. And but the reason the quantity surveyor gets there is around the construction cost and minimising that risk of it being wrong and getting the maximum deductions as well. I'd like to bring attention here to our institute, or the Australian Institute of Quantity Surveyors. Over the last couple of years have tried to, I guess, get the traditional quantity surveyors to understand depreciation a little bit better and get a bit more consistency in the reports that are provided by the industry to the consumers. A couple of things in regards to the practice paper that's been put out that you can get, we'll give it to you, or you can get it from the RQS website. There's a few things that were brought there. The industry was involved in preparing this, and a couple of things that I guess we try to make sure that are always done and have stuck by, that I think the ARQS has sort of added into this, and they include, firstly, I guess, site inspections. We've always believed in inspecting properties. Our industries, some have decided they can do it from photos, etc., which we don't agree with. And then if you read what this paper says, I think the ARQS would suggest that, in order to minimise risk, maximise the deductions, and capture everything, the site inspections are a very important part of the process. Otherwise, they need to be disclaimed to say it might not be accurate. So we believe it does actually get the best result and the most deductions, because we go in there, we find everything, and we're not scared to put it on there. Referral fees, we've been a non-referral fee paying to the accountants and the financial people of the world that refer to us. There's about 18,000 referring accountants to BMT. We don't pay them for that. We just try to maximise the deductions and do a good job. Make sure that the things are turned around and make it seamless for the client. Referral fees not aligned with our QS kind of conduct as far as we're concerned, and disclosure needs to be given. So you want your money to go into making sure depreciation schedules prepared properly, as opposed to slippers of money to the accountant for the referral. So always ask that question. Now, I think the easiest way to get an idea of what it means for an investor is, what if we do and don't claim depreciation? I'm going to run a very simple couple of cash flows here, or a cash flow on an investment property that gives an indication of what happens if we do or don't claim depreciation. Now, I've actually got an app that we've built. We'll have a look at a bit of detail later, called PropCalc. You should write that one down and probably download it. It's free. It's in the App Store, Apple and Android. And it is a way where you can actually calculate these numbers yourself on your own property or properties that you're looking at, which is, I think, crunching your numbers before you buy property is very important. So you really know what the after-tax cost of owning it will be before you go headlong in and buy it. Let's run through this scenario to see what depreciation actually does to it. Let's take a 4-bedroom house, $820,000 purchase. We'll get some rent for that, which is great, $700 a week. Let's say that is going to provide us income of $36,400 for the year. We'll have some expenses in order to keep this property: rates, management fees, interest, that's a big one, insurances, etc. That would be about, we've assumed, made a few assumptions here, so that's $50,200 for the year, or about $52,200. What it means is we're going to have to kick in $13,800, or about $265 per week, in order to hang on to this property. Not fantastic. However, it does get a little better. If we make a loss in operating an investment property in this country, we do get to make a deduction for that loss against our other income. This is a negatively geared property. So what happens here is that we kick in $13,800. With that loss, we write it off against our other income. Most investors have a marginal tax rate of 37%, meaning as they make their income, our mates in Canberra take some, and it's usually 37% for most property investors. We make a deduction for that 13,800. They give us back 5,106 at the end of the year, meaning the property drops down to a cost of $167 per week. Simple, money in, money out, make a deduction for that. No depreciation accounted for here. We have a look at a new property of that sort of value. We believe the first year deduction would be around $16,500. So what that does to this scenario is that we've still got our $13,800 that we pay out. We've now got a $16,500 deduction. That's the stuff wearing out. The bricks and mortar, the carpets, everything is wearing out, and we're making a deduction for that wear and tear. It's a non-cash deduction. So it makes a big difference because you don't actually pay for it. We've got a $30,000 deduction now, meaning we're going to get $11,200 back for the tax office. And our cost to own the property is now $2,589 per year, or about $49 per week. So depreciation, no depreciation, difference is $117 a week in the cost of owning this particular investment property. Big difference, probably as much as you're paying management fees. We're trying to maximize the cash flow on these properties, and my job on this whole page is really just that one number, that $16,500. How do we come up with that? Make it as high as we legitimately, of course, can. Something that will stack in the questions from the tax office, which we're very confident of after so many schedules. But it does make a pretty big difference to the cash flow. From our research in the past, somewhere between 70 and 80% of people are not maximising this deduction. They leave it at the tax office for some reason. Maybe you like the way they spend it instead. I don't necessarily. We've just had a budget and it goes wherever it goes. But making those deductions and maximising those is something that as an investor we really should try to do as best we can, I think, if we're going to invest to try and make money. Now, not to run completely through again, but there is some people that do make more money and are on a top marginal tax rate of 45%, we can see here. And what that does is make just even more difference. Now, $146 a week pre-depreciation turns into $3 a week after depreciation, $143 a week difference. The reason that happens is because obviously the deductions you make are more valuable because you get 45% of them back from the tax office. But this property, if you're on a full marginal tax rate, comes back to something that costs you $3 a week to own. It's not even enough to buy a cup of coffee. So obviously you can buy more of something that costs you less money, but then obviously you may run out of tax deduction availability. So, but anyway, things to consider: more deductions, more difference when you are on that higher marginal tax rate. Second, another case study here that we won't run through in as much detail, but what I really want to do is just bring to your attention that secondhand property still gets depreciation. Doesn't get as much as new property, and we'll get into some of the reasons why, but it still makes a bit of a difference. We've got something here built in '93, so it's 20 years old. Its deductions go from -275 pre any tax to 174 after we make a deduction for our loss. We've got $7,800 in depreciation, still makes $56 a week difference to the cost of owning that property. People think older property sometimes doesn't get it. It doesn't get as much, but it does get some. Let us work out whether there's any money actually there. $7,800 still is a decent deduction. And this is not just for 1 year. These deductions keep going on into the future. So a new property has deductions for 40 years. This property that's 20 odd years old still got another 20 years of making claims. So there's deductions there and available, that it does make a difference. Now, blanket called it depreciation so far, but it's actually split up into two areas. We'll get some little bit of technical here, so you got some understanding of how it works. One's what's called the capital works or Division 43 allowance. This is the hard stuff: concrete floors, the walls, the roof. The things that last a long time. Tax office tells us 40 years. So 40 years of claiming against that structure is what happens. It needs to be built after a certain date in order to claim this deduction. It needs to be built after 1987 as a residential property. And how it works is, if something costs to build, we'll use the example here, $320,000 for the structural component in 2014. An investor who owns that property, if it's an investor, will get 2.5% of that as a deduction against that structure each year. $8,000. Fair bit of money, obviously. If you were to buy this house now in 2024, you don't get it for the first 10 years, but it does go for 40 years, so you've got 30 years left. 30 years of claims left for you as the subsequent owner. Excuse me. So $8,000 is fairly substantial. This does apply to new and existing properties and also to renovations, even if they've been done by someone else. So if you look at a property that's been built in 1950 and then in 2015, someone's added another room to the rear, put a new kitchen and bathroom in it, then we look at the money that's been spent here, and there might be some deductions for this building allowance after that time. So big numbers in there because it actually costs a lot to build properties, basically. It's another reason that one reason that new property gets a bit more in deductions. New properties usually cost more to build than they did similar things 10 years ago. So more construction cost in there means, 2.5% of that each year, more deductions. The other part called plant equipment, things that are usually easily removable, mechanical, fixtures and fittings, they're claimed over what's called their effective life. So the tax office tells us the dishwasher has a life or should last around 8 years. So if a dishwasher was $1,360, gets a rate of 25% in the first year, $340 in the first year, and diminishes over time. It's a diminishing value rate, so it actually is claimed based on residual value each year, but it's obviously a lot higher than 2.5% on these plant items. So the more of those we can find, the better. Now in residential property, in order to claim against these plant items, they actually need to be new. A legislation change in 2017 said that we only claim on new plant equipment items. So anything previously used, you can't claim for. Commercial properties, you can claim on previously used things, but in residential properties, you can claim on things you put in yourself that are new, or things that are new when you buy the property, they're obviously new. So this is a reason that secondhand property, one of the reasons secondhand property doesn't get quite as much as new property also, because you don't get to claim against these fixtures and fittings. Types of amounts of claims that have come up over the last financial year. We haven't finished this one yet, so we'll see how those numbers compare. But interesting, the 22-23 year, out of the mid 40,000s of depreciation schedules we did, the average deductions for the properties come out as we can see on the table. We go to the bottom there for the brand new. It's about 28% of the jobs we did last year. First year average deduction about $15,000, just over, which is great. As we can see, there's not quite as new properties don't get quite as much. But one thing that is quite interesting, I think, is that pre-87. Pre-1987, we get nothing on the original structure of the building. We still got an average of $5,126 out of those jobs, and they were 14.5% of the jobs that we actually did last year. So there's quite a few old properties there. Obviously, they've had some sort of renovations at some point, or someone's renovated them to get those average deductions. But once again, old property still gets deductions. We always want to ask that question. Overall average for the year out of the properties we did, just under $9,000. It's I think was a little lower than the year before, probably a bit lower. We've obviously done a few more of the older properties in this year, but that's just the way it goes. Sometimes those percentages change, but that's what last year's numbers look like. The other interesting thing, secondhand properties that couldn't claim on previously used plant and equipment still had an average claim of $6,348. So that is anything that's been built after 1987 and purchased after 2017 that had no brand new plant, or wasn't that were not new. So they had plant equipment that was secondhand that we couldn't claim on. So still quite substantial reductions. Guess the point is, whatever type of property, it's always worth asking the question to see if you can get some deductions out of it. Renovations. One thing we did do is run across about 100,000 of the properties over just after COVID, actually, when a lot of our industry decided not to visit properties anymore. We kept visiting them, we held on to them and visited them. And we found that out of that 100,000 properties, that 66% of the time, they had some sort of renovation or addition that qualified. So even so doing it from past photos, or even if the original costs are available, which we use if we've got them, 2/3 of the time there's something else being done to that property at a later date that we need to make sure we pick up in the process of doing depreciation schedule, so you can maximise the deductions. So 2/3 of the time without an inspection on an older property that's got some original costs, you may be missing out on deductions by not visiting it and finding everything and going to site. But on renovations, I'd like to touch on how to treat them regarding depreciation. On the bottom here, after a renovation is done, which is when most people think about it, you spend more money. There's more things there, more stuff there, more plant, more building, more whatever it is. Money's been spent, so therefore depreciation will apply to those things that have been added to the properties. People get that a lot of the time. They call me when they've done renovations. But one thing to make sure that is taken advantage of is what we call scrapping. Before you rip it apart, you should be talking to the quantity surveyor to make sure, and all you're doing that for is to make sure that there's a depreciation schedule in place for the things that are in that property. Now, if you've already got a depreciation schedule, you don't need to talk to us before you renovate, only afterwards. But if you're going to renovate, not sure whether you could have claimed anything, it's an important time to make sure you assess and see if there's anything of value left in there for the purpose of depreciation. If there's not, we'll tell you there's not. If there is, and you rip some of those things out, they may have had some tax value left, depreciation left in them. If you rip them out and throw them away or scrap them, whatever available or whatever remaining value may have been on those items could be an instant deduction the year that you throw them away. So if you do have a bit of a renovation on a property, this can mean some fairly substantial deductions in the year that you actually do that renovation, which is probably a handy time given that you probably spent a bunch of money and usually more than you expected on renovations. This applies both to the plant items and to the building allowance items. And I'll give you an example of where this can be quite, powerful in bringing you some deductions. Take a house that's say 30 years old that has a 30-year-old kitchen in it. 30-year-old kitchen's starting to get a bit on, and it's quite possible that you may be thinking about renovating something of that type of age. If you rip out a kitchen that's 30 years old, it's seen as part of the building, so it's got a kind of a 40-year life. You've only claimed 30 years of it, or someone has claimed 30 years of the value of that kitchen. So there's really 10 years or a quarter of it left. So there's potential for an instant deduction for writing off the rest of the cost of that kitchen in that 1 year. If that was a 40, for round numbers easy, if that was a $40,000 kitchen back at its day and you're ripping it out with 10 years left, that could be a $10,000 instant deduction the year that you rip out that kitchen and throw it away. So before you throw it away, make sure the quantity surveyor has done a proper depreciation schedule on what's there so you can take proper advantage of that scrapping value. Commercial properties, we are in a residential webinar today. I've done commercial webinars today and yesterday as well. Full detail on those, they're available if you want to get a hold of those, but it does also apply to everything: warehouses, restaurants, pubs. I am surname of beer, so we like pubs. Like to sample a beer if we can while we're there. Not while we're there, after work, of course. Farms, a lot of changes in farms over the last little while. Lots of instant write-off in a lot of those farms and areas on things like fodder storage, fences, and so food storage, fences, the dams. That's right, the ones that hold the water. Lots of changes in those areas over time. They don't have any of these plant and equipment rules from 2017, so quite lucrative deductions available all those types of properties, and we've done many of those over time. Simple case study: 800 square metre industrial unit, first full year $30,000, 5 years 130, 40 years 1.2, obviously about $1.2 million to build that particular facility. So quite some substantial deductions available. Try to answer the frequently asked questions today, the ones that we get asked all the time. These are the type of questions that I know you guys ask, so that's why we put them in here, I suppose. One that is the most prevalent all the time is, doesn't my accountant look after that? Or, I have a good accountant, why do I need you guys? And the answer is we work alongside them. We do that one piece of the tax return, that is the depreciation schedule that comes up with that one number, and we want to maximize that number. We visit the site, we take risk away because we estimate that construction cost, and will be recognised by the tax office to do so. Accountants are not recognised to do that. Neither are real estate agents or valuers for that matter. We come up with those costs. The tax office should accept, or they might ask questions, but accept, or that a quantity surveyor knows how to cost them. We just get more money out of them. Most of the jobs we do come referred by accountants. I think there's, I may have said before, there's about 18,000 referring accountants to BMT, and they send them to us because they want to maximise that deduction and help with your tax return. To, you know, we make them look really good. We get these tax deductions and give them to them, and hopefully get more tax back at the end of the year. Old property, I've touched on it. I'll harp on it because it's never too old to ask the question. People are still saying every day, is it too old? But it's old, but it's not new, but it's 7 years old. Forget all those, just ask us, send us the address, we'll have a look at some photos, we'll work out whether we think it's worth doing before we ever go ahead and do it. Now, is it ever too late? I come along today and I've realized I've got a second-hand property, or I haven't been doing it properly. You, like many others, you can actually go back and get some from the tax office if you've been missing out, or some money, hopefully. You can go back and amend pretty easily to tax returns. So a bit like, I guess it's a bit like if you don't pay your tax, the tax office will find you and make you pay it eventually. They go back, I think, forever. I don't know how long. But on the other hand, you as an investor can go back and say, last year I should have claimed X, and I only claimed either 0 or Y. You can either claim the total that is there, or you can claim the difference between what it could have been, or what it was, and what it should be. 2 tax returns pretty easily. So the important thing there is, well, first, talk to us, work out whether there's some more potential there, deductions. You can use the depreciation calculator online for free, or you can just talk to us about the property. Then if there's a difference between those numbers, don't do another tax return and miss out on another year. Get some activity happening before you do another tax return, so you don't miss on another year that you might be able to back claim on should you be missing out. There is so much potential in there, especially if you've owned property for a few years and you haven't been doing anything, because it's, you know, it's amending previous tax returns and getting money, and there'll be depreciation claims going forward. Capital improvements versus repairs. I like to mention, because it's a question regularly, if you improve your property, then the improvements will be added to a depreciation schedule and depreciate over time, whether it's the building or plant and equipment over their effective life or whatever it is. If it's repairs or maintenance, it's an instant claim straight away. Obviously, the more of those we can find, the better, but they need to be repairs. And I think I've seen a few articles again, because it's tax time, that the tax office is once again focusing on investors, and one of the main areas they will focus on will be repairs and maintenance that's not really repairs and maintenance and should be depreciated, or interest claims. I think I've read that article every year in May forever since I've been in this business, but you know, maybe it's just a focus area this year. They do focus on some of those things, but that is an area that you need to be careful of and make sure it's done the right way. We work with the accountant on those things. We leave out the repairs and maintenance, and we depreciate what should be depreciated. Capital gains tax is a question that we do get asked. If you claim depreciation, does it increase your capital gains tax? Yes, it does, because it reduces your cost base. When they do the calculations for capital gains tax, the cost base from the start will be reduced by some of the claims that you make. So when you sell, you'll have a lower cost base and therefore a higher capital gains tax liability. When you make depreciation deductions on the way through owning a property, you make them at your full marginal tax rate. When you sell a property, providing you've owned it more than 12 months, you usually be able to take advantage of a 50% reduction in the capital gains tax in the value or the amount of capital gains tax that you do have to pay. So we've run a bunch of case studies on this over time. They're in the Maverick newsletters on the website, or if you can't find them easily, email me and I will get you those. When you run the numbers, the money that you get by claiming it generally will outstrip the money that you lose in additional capital gains tax at the time if you sell. There's also the fact of the time value of money. You get your money each year in your tax return, or you can get it actually taken out of your wages on the way through if you really want to get fancy. Talk to your accountant about that one. But you get it each year, you get to use it, you have the time value of money to consider, and You can use it to reduce debt, therefore pay less interest, put into offsets, go on holiday, buy a boat, whatever it is. Probably not great advice, those ones. But you do get to take advantage of that money, and you do get more of it on the way through with the time value. And with the time value of money, it's, you know, to me, makes sense to claim on the way through. But yes, you will have a higher capital gains tax bill at the time when and if you do sell. Important things to be included. We project it for 40 years. I say that, but then we give you free access to My BMT, which means that you can update it with only a few items for free over time. So if there's only a few things, you can update it, because we do it for 40 years. So you only have to do it once. But obviously, if you put a new stove in 3 years later, my crystal ball's not good enough at knowing that. So therefore, we have to do what's there at the time, and it needs some adjustment to make those numbers right at a later date. But it does have that projected from the start. Make sure it's got all the costs of the items and the effective life and the depreciation rates available are always in those reports. There's a couple of different methods: prime cost, diminishing value, and also low value pooling for lower cost or low value items. We apply all those things. We give you the different schedules for what they are. They mean more deductions early years and less spread depending on which one you choose. Now, we've run case studies of prime cost versus diminishing value with explanation. I'm not going to try and give you all of that today, but they are available on the website, or email us and we can give them to you so you can understand the differences. But usually your financial helper or your accountant will look at the reports, and based on the methods that we provide all of, choose which is best based on your financial situation. If you want the detail though, we can give it to you, absolutely, but not within this time frame today. Split reports. If you are multiple owners of a property, we split these reports up. Splitting reports up does mean that you do take advantage of some increased deductions per owner in early years. I'll say most of the time, because it doesn't always change it. It depends on the percentage of ownership, etc. The reason for that is that we actually sort of split the value of the assets and then apply the tax rules. And it can mean that some things of low value get claimed quicker at the start. We give you split reports. There's also the overall report. In order to maximize the deductions, a split report is the way to go. Some accountants don't like to use them. Sometimes it's not a massive difference, and that's okay, but we do give you the main report that you can use if they just want to split it their own way. But we do those split reports, absolutely. We copy them into your accountant, provide them in CSVs, Excel, PDFs, so you can get them into wherever you need to get them. How do we get the most out of it? Well, we want to get everything, and that includes the common areas. So if you own a unit in a unit block, then you own a piece of the underground car park, a piece of that lift, a piece of those common areas, basically. So you get to depreciate your piece of them. I've seen depreciation schedules excluding common areas before, which I don't agree with necessarily, because you don't get all your deductions. You own a piece of those things; they're expensive. Furniture is plant equipment, so providing it's new and not previously used, then obviously you want to include that and get it. The more plant equipment items we can find, the better. We get deductions earlier, making sure we know the rules, and making sure we cost things properly for the purpose of depreciation. When we put a value on a plant item like a hot water service, you might think it looks a bit more than what it cost you at Bunnings to buy one, because it's about supply, installation, and the cost of getting it there for the purpose of depreciation, which is a bit higher. Excuse me, often. A few things I hope are a bit different at BMT. Firstly, we use our own guys to do everything, guys and girls, our own team to do all our site inspections. Nationally, my people are not contracted to do that. They're trained by us to come out professionally, meet your tenants in their suit and tie, as much as they love it sometimes, go through that property, trained to collect every bit of information that they need to make sure we maximize those deductions. Double the fee guarantee. If you have an older property and you're not sure whether it's worth it, and I want you to talk to us and we'll check whether we think it's worth it. If we think it's worth it and we say, let's go ahead and do it, then we will give you the guarantee that unless we get twice that fee in the full financial year, even if we've already done the site inspection and done some of the work, we'll call you and say you can cancel this if you want to, and you don't have to pay anything, because we should have asked enough questions to know that at the start. We try to make sure we identify that before we go, of course, so that we don't have to give back your money because that's not good for business. But it is not good for anybody if we charge you money and you get nothing for it. So there's a guarantee to make sure that isn't the case. Make sure we comply with the ATO. The average first year is almost $9,000. We are flat fee, $700 plus GST across Australia for a standard residential property, and it is tax deductible. Best to order and pay for that prior to the 30th of June. When you can order it after the 30th of June, but it just means you'll claim our bill next year instead of this year's tax. So if you're going to do it for this year's tax, then doing it before 30th of June is a good idea. We have had some challenges with the turnaround time over the since COVID, up until recently, where we're back to normal turnaround times. We need to get access to the property, obviously, work around a tenant wherever we are. That normally takes, well, depending on where it is, might take a week or two. We're turning the jobs around in 5 to 7, sometimes 9 days at the moment, depending on getting the information, etc., in there. So those challenges around turnaround time we've got on top of, and intend to keep it there with enough resources. So we should be able to still get it pre-financial year if you get it soon. But you don't actually need the report before the financial year. Best thing is to order it. You just need it ready to do your next tax return. And before you do another tax return, you want a back claim, of course. My BMT, I'd like to show you a little bit about this. This is the portal we built that I mentioned earlier that's about making life easy with some cool, fun things in there that are free that you can use as an investor that are really very handy. First thing, and the reason we built it is around being able to update your depreciation schedules each year. Share it with your accountant. So the two things, sharing with your accountant and update. So out of the accountants, don't know how many, can't remember exactly how many accounts on there, but there's 120 or 140,000, I think, users of our BMT overall that have got a depreciation schedule. They can see it in there, and I'm sure they look at it every week. No, they don't. But once they do it, they can then share it with their accountant. The accountant has one login for all of their clients. So if an accountant wants to get on, see a depreciation schedule, rather than looking around in the file for the PDF or whatever they do, they can just get into their login and they can see your schedule. The other benefit for them is they can see if you've done updates. So if you as an investor buy a new stove 3 years after your depreciation schedule is bought from us, you can go on for free, put your stove and what you paid for it in there, and it will update the schedule, and your accountant will get the new numbers for that year, which makes it easy for the accountant. It's quite simple for you. We've put some other features in there, which I'll touch on in a moment, but that's the main core things behind why we built this thing. As you can see, you put your carpet in there with the date and the cost, and it updates the schedules. You can add and remove the assets and reshare them with your accountant. The accountant can tailor to see what they want to see. They might want to see diminishing value or prime cost or just this year, and they can go in and sort of tailor a little bit to what they're after. The research and insights tab, this is a good one for you as investors, for mainly around this valuation or AVM. When you go to the bank to borrow some money or to refinance, the first thing they'll do is they'll go out to the valuation houses or wherever, to get what's called an AVM or an automatic valuation. They get that from a price finder or a CoreLogic, where it automatically looks at the values of properties around your property and spits out an approximate valuation that, obviously, if it's close enough, they use it, or they get a valuer and go through a different process and actually go and visit the property. Those same companies that provide that to the banks, we've got hook up with there, and for free you can see what the AVM is. So you can get in under that valuation tab, and for the properties that you do own, that you've had a depreciation schedule on only, not for everything, because we do actually pay for those, but you get them for free as a BMT client. You can get those AVMs, which is handy. Notification of planning applications of near the property. This one's also does cost us something, and it's free for you. If you, as a BMT client, if someone's put in a DA to build a 20-story high-rise 3 doors up the road from your investment property, and you kind of want to know about it, this actually sends you some applications, some notification that there's an application being put in near your investment property. So that is something where you get onto the council website and it will see, you'll be able to see what's happening around your property. Income and expenses, once again, another free thing that we've built in here that you can use as an investor. And as you go through the year, and now it used to be a shoebox, maybe it still is for some people. Now it seems to be a whole bunch of PDFs of invoices and all sorts of things that you get. Here's a spot, you can actually enter them all into the one spot. It's actually set out in the same format as the MyGov ATO website where you need to do your tax, or your accountant does your tax. It's actually set out the same. It spits in your depreciation number, and because you may be hooked to your accountant, you can share it directly here with your accountant. Lots of people are using that. It's free. We don't do anything else with it at all, other than it's a free service, so we didn't even really advertise it. People just found it and started using it. PropCalc I touched on at the start. This is the app where you can actually calculate and crunch the cash flow, the true after-tax cost, after-tax holding costs. It's an app. It also sits within My BMT, where you can see and compare as well other properties. You put the details in, the costs, the income expected, work out and put your tax rates in. You can put in different deposit amounts, different interest rates you think you're going to pay, and it'll give you what the cash flow should be on that property. You can save and compare different properties. It also gives you some of those research and insights tools around median rents in the area, and spits out the negative or positively geared result based on the information that you put in there. So handy tool. If you're looking at properties, you should be crunching your numbers, and this is a simple way to do that. And you can compare different properties side by side if you're logged into that as well. So very useful tool and free. Some more tools there that we've got for investors. Depreciation calculator. Look, you can talk to us about your property, but you can go on in the middle of your night when I won't be answering the phone and use the depreciation calculator to come up with some sort of depreciation estimate for a property. You can put the age of the property, a few little criteria in there. It'll spit you out a rough estimate. Rep cost or replacement cost for insurance. That app is something that can help you to estimate the replacement cost of your house for insurance purposes. So it is free, and insuring your house for the correct amount of money is something that is not necessarily a dark art, but it's something that the consumer doesn't necessarily know how to do. That can help you. We're quantity surveyors, we understand construction costs, but insurance companies seem to let you tell them what you think it might be most of the time. We are also an insurance broker at BMT. BMT Insurance Brokers does provide house and contents and landlords insurance. So we do have products for that if you're interested as well. Resi rates and rate finder gives you all the rates and the effective life of all the items that are in the property. There's about 180 items 170 items in a residential property that are those plant equipment items, and their effective life is in there. Construction cost is the app that is actually quite well used. We publish construction costs on the Maverick newsletter. We also build them into this app. So if you are building or developing, you've got some of those square meter rates that you can see inside that app to help you to estimate the approximate construction costs of what you might be building. Process, pretty easy. Talk to you when we need to talk to you before you buy it, so you can crunch your numbers. When you settle, you want to get the deductions. Tax time, you're thinking about them. Tax time coming, so you might need to think about your last 2 years as well, in case I haven't said that 3 times already. If you renovate, before you pull it apart, that's the time to talk to us. After that, we take the information, we make sure it's going to be worth it. We will go off to the council and find the age, and we'll find as much. There's a fair bit of property data we can get a hold of now. What we can find, we'll find, and then we'll have to ask you for some things that we can't find. We don't know the investor property until you tell us, for example. From there, as I said, my staff come out, they do an inspection, prepare the report, start claiming the depreciation, get thousands of dollars. That's the plan, basically. We try to do it like we have the best part of 1 million times. Fees for depreciation schedules, I think I mentioned, is $700, $700 plus GST, so $770, which is tax deductible. Do it before the 30th of June and pay for it so you can claim it this year. I look forward to helping you out to maximize these deductions, get some money from the tax office. Thank you very much for listening.